Good morning, students for Financial Accounting 2601. This is a video presentation on the subject matter IAS 2 inventory, and you can find your inventory study material on the Moodle platform under your Moodle platform lessons tool 4. There is a lot of material that you can work through, the theory, which is obviously very important, and the study material, the self-assessment questions, good stock questions, the Kele-Bugile question, and we are specifically going to look at this stock question, which has been upgraded to include a very important section. And that is what we will be discussing today, and as well as additional notes, inventory on journal transactions, the journal solutions, and then the material errata of the study material. This is just an indication of how to browse through your Moodle platform. Now, colleagues, what's most important, please note that I unfortunately is not going to spend time going through the theory with you, which is obviously very important, and that is you need to go through in your own time. I believe that this section is best explained if we look at a specific question dealing with critical matters. Okay, as indicated before, whenever you get a question, you can go to the required to know exactly what is expected of you. Since this required, prepare financial statements that includes the statement of profit or loss and other comprehensive incomes and relevant notes with regards to inventory. And we need to go and look at this inventory section where we can immediately see that we are dealing with inventory, where it's purchases for the year, transport cost, fixed production overhead, and variable production overhead costs. Now, from the theory, you will know that overhead costs are ongoing expenses involved in operating a business. Now, a company must pay overheads on an ongoing basis, regardless of how much or how little the company is selling. And these type of costs are known as overhead costs. The costs that you see here are specifically the actual amount of costs included in the production for the year. So those are the physical cash paid balances during the year. And from theory that you will learn in your study material is that variable costs, which include, obviously, that they must spend money on producing items, marketing and selling its goods or services, and these are known as overhead costs. Now, fixed overhead costs are those costs normally constant and do not vary as a function of productive output. All right, this include items like rent or a mortgage and a fixed salaries of employees, whereas variable overhead cost varies with the productive output, such as the energy bills, raw materials, or commissions on employees paid. Now, overhead costs are costs that do not change as indicated, and they are fairly predictable as these are fixed costs, overhead costs, and are necessary to keep a company operating smoothly. Okay, so typically fixed overhead costs can include the rent of the production facility, the salaries of the plant managers and supervisors, depreciation expenses of fixed assets, taxes and insurance. Okay, whereas variable overhead costs are costs that actually do change as the volume of production changes, the number of services provided changes. Variable overhead costs decrease as production output decreases and increases when production output increases. All right, and they might include items such as supplies, raw materials used in production, direct materials, and sales commissions. All right, so in normal circumstances, we can not allocate fixed production with ease to the production costing of the items that you produce, and therefore under normal circumstances, whenever you operate under normal capacity, the company have realized that if they produce 2,000 units, they can allocate a standard unit rate of say 50 Rand per unit to this specific items that you've produced. Okay, that is under normal circumstances where you can allocate production units per rate to these items. And that, colleagues, is when you will get over or under recovery, is when we know that fixed production overhead costs are allocated to the production based on normal capacity. You will always allocate it based on normal capacity. But let's work through this question that deals specifically with these items, and we've also thrown in a curveball for you where certain items are only 60% complete that has been issued from the purchase department. Okay, so in this scenario, stock is a manufacturing entity of laptops, and the following information for the year ended is given to you. So revenue is the amount that you've sold for your laptops. Then you've got your administrative expenses. Then you've got your selling expenses, the raw materials that you've purchased during the year. You've got transport costs of raw materials to bring it to its current location and condition. Then the actual fixed production overhead cost for the year is 114,000. Then your variable production overhead cost is 138,190. Then they've given you employees' wages. The rate per hour, it takes 1 hour to assemble a complete laptop in the work in progress or the assembly department of 850 Rand per hour. Okay, so that is the rate that it takes to assemble a complete laptop. Then, colleagues, they've given you inventories that consist of the following. You've got opening inventories, closing inventories, and net realizable value. As from theory, you know that when we are going to draft the annual financial statements and the statement of profit or loss, you know that cost of sales consists of your opening stock plus your purchases less your closing stock. All right. So therefore, your cost of sales is the section in a calculation that we will have to calculate regarding your raw materials, your closing inventories, and net realizable value. As you also know that IAS 2 is obviously measured at the lower of cost and net realizable value, so that we don't over cost, or there's not a item or a cost that is more than the cost that it will realize in a normal sale. So therefore, the net realizable value is given to you per item on item basis. Now, what do we know from the raw materials? We need to calculate those items that are obtained or as opening. What have you purchased and what is being transferred from it's been issued and transferred to your work in progress and then to your finished goods section, so that we can get the cost of sales for these items that are sold. All right, colleagues, let me take you to this calculation. Then you can work with me together with the items on this section. So what are we after here? We need to draft annual financial statements as well as providing the notes for the year as given to you in the required section. Therefore, once you've realized that you need to draft the financial statements, you can go up and draft the annual financial statement section as well as the notes that we will complete the figures afterwards. Therefore, Stock Limited is the name of the entity and the heading is the statement of profit or loss and other comprehensive income for the year ended 31st December 2025. You deal with revenue. Yes, we can immediately include it there. 3280,500. Cost of sales, of which we don't know yet. Okay, then you will get your gross profit. Other expenses, your administrative expenses as per the function method. Okay, statement of financial position as at 31st of December 2025. Assets in inventory consists of and falls under the classification and category of current assets. And inventories will be disclosed at the lower of cost and on net realizable value. And that will consist of your inventories as at year end, which we will calculate. Okay, we can immediately see that your raw materials inventory have got a closing figure of 41,250, raw materials 41,250. Your work in progress is 70,125, and your finished goods, can we see here, is 3,985. which is given to you. But we know that your inventory must be disclosed at the lower of cost and net realizable value. And then the question will raise now, but why, if inventory or raw material is at 41,250, why have we not write it down to 39,875? Because the standard tells us that we need to write it down to the lower of cost and or net realizable value. But that's something that we will come to in the question. So colleagues, how do we go about this question? Now let's go to the calculation and see the information as we take it from the additional information. Now they've given us the opening inventories, which is 96,250 for raw materials. They've given us packaging materials of 48,800. They've given us work in progress of 41,250 and finished good items. That is your starting off point for the calculation of cost of sales. Now, colleagues, I will show you in tabular format how do we deal with these items, because what are you using? You have to use the raw materials for the specific items that you need to use, and then it needs to be transferred to work in progress. From raw materials, you transfer it to work in progress to your finished goods section. Okay, and I will show you in a tabular format. Now let's go to the additional information first. Raw materials and work in progress are valued according to the first in, first out method, and that's the FIFO method. That's the accounting policy note that how these items are valued. Finished goods and consumables are valued using the weighted average method. Okay. So finished goods and consumables are valued using the weighted average method. Fixed production overhead costs are allocated at 50 Rand per unit and is based on the normal production capacity of 2,000 units. This is where I've indicated to you that under normal circumstances, the company can allocate fixed production overheads to production based on what they normally produce. So in this instance, this is a fixed figure where they can at ease allocate production or a Rand per unit to the fixed production overheads for the year. But that is not what was actually incurred. So during the year, you will allocate fixed production overheads to the premises or to the productionists, and then we, at the end of the period, we can see the difference between what has been allocated and what was physically incurred. Okay, to either have an over recover or an under recovery that we must add to your cost of sales figure. Okay, and we will show you that. Now, this is a curveball that has been thrown in from the previous question, stock question. All right, this indicated that a total of 2,000 laptops were issued from the purchase department, and 600 laptops were still in the assembly department, and a total of 1,400 laptops were completed. Okay, so now we have included that 2,000 laptops were issued from the production department. Okay, and the 600 are still in assembly. They're not yet finished, and 1,400 laptops were complete. But now, with that, we say laptops in the factory or assembly department were 60% complete. So how do we deal with that if something like that comes up? Now let's go and look at the calculation. Colleagues, it's critically important that you follow this and the section here that will help you a lot in determining the cost of sales figure. Let's bring it together from the items on the left, where we give you the opening stock, the closing stock, and the net realizable value. So raw materials, colleagues, as you can see here, what is the opening balance? Well, they gave you the opening balance of raw materials of 96,250. That is given to you from the information. What is this closing stock figure is 41,250, but we can give the closing stock figure there is 41,250, and the NRV, the net realizable value, is 39,875. They've given that to you. The question here is, why are we not writing it down from closing stock to net realizable value? But that is something that we will come to. We first need to determine what is the cost of sales. Okay, so for these items, we can clearly see that raw materials were purchased during the year of 247. So how do we calculate cost of sales? Well, you've got your opening stock plus your purchases plus other costs less your closing stock. That is how you determine cost of sales. So here we go. Plus purchases and transfers, that's 247,500 for your purchases of raw materials. What are the other costs? Well, the other cost that's bringing the inventory to its condition and location for completeness sake is 700 Rand. So those are other costs of 700 Rand. Okay, so less the sales transfers. So what we are doing here, we are taking the raw material cost and we transfer it to the work in progress, the WIP. These are the costs that we need to transfer to your work in progress costs, because those are the costs that we use from the raw materials, and we just transfer them to the assembly department, the work in progress department. And that is why you will see that this figure 303,200 is the balancing figure. How do we get 303,200? Well, you say 96,250 plus 247,500 plus 700 less 41,500. That is the cost of raw materials that we need to transfer to the following department. Okay, and that is 303,200. Okay, that is the balancing figure as we indicated to you here. All right, so raw materials and work in progress held for use in the production of amenities are not written down below cost if the finished product in which they will be incorporated in are expected to be sold above the costs. So now you can see, colleagues, that the closing balance of your raw materials is more than the NRV. In normal circumstances, we would have written it down from 41,250 to 39,875. But the standard tells us that no, you cannot do that, that if raw materials and work in progress held for use in the production of inventories are not written down below cost, if the finished product in which they will be incorporated and are expected to be sold at or above the cost. In this scenario, we are certain that these items will be sold above their cost, and therefore these items, raw materials and work in progress, are not written down, as well as the finished goods are not written down to below their costs. Okay, but that excludes your packaging material, your consumables. Your packaging material does not form part of that section. It's completely separate of those items. Now let's go back to your work in progress section. Okay, work in progress section, they've given you your work in progress, they've given you your opening stock, which you fill it in, 41,250. Where do we get the 303,200 from? Well, that is the transfer in costs from the raw materials. You take your costs, because remember, we are after cost of sales. What are costs of sales? The opening stock plus your purchases plus other costs less your closing stock. So that is exactly for the same departments. We are after the closing stock figure. We've just determined the 303,200 coming from your raw materials, and you transfer that into your work in progress stock. Okay, then colleagues, we are dealing with the other costs. 354,720. What does that consist of? Now, colleagues, this is very important section, because remember, the additional information tells us that in your assembly department, okay, we have a total of 2,000 laptops that were issued from your purchase department, and 600 laptops were still in the assembly department. We're looking at the figure there now in yellow, okay? But the question states that from your purchase department, 600 laptops were still in the assembly department, and a total of 1,400 laptops were completed. So what are we determining? We are moving towards this other costs calculation section. This other cost section we are dealing with here are now other costs that we need to determine. Now, 2,000 was issued. 2,000 laptops were issued to the assembly department, whereas 600 of them were completed, were still in the assembly department, and 1,400 were completed. But hang on, here's another curveball. They tell us that laptops in the factory assembly department were 60% complete. So, colleagues, of the 600, how many were completed that we need to cost? And that 600 times 60% gives you 360. So the total amount of items that needs to derive costs from is 1,400 plus 360 gives you 1,760. Remember, that is the items that we will calculate the other costs from. Now, other costs consisting of, in the information, your fixed production overhead costs. But remember, fixed production overhead costs are allocated to production based on normal capacity, which is 550 Rand per unit of 2,000 units. Okay, colleagues? But now we've determined that the other costs include your variable production overhead cost of 138,190. Okay, so now let's go and calculate the other costs, the 354,720. How do we calculate that? Well, it consists of employees' wages of 850 Rand. Remember, they told us that employee wage wages is 850 Rand. It takes an hour to complete a laptop. Well, 850 times as 1,760, that is the laptops completed in this scenario, in this instance, because only of the 660% are complete. Therefore, 60 is 360 plus the 1,400 that is completed, give you 1,760. Now, of the 850 times the units is 1,496,000. But we cannot. We need to allocate only the section to work in progress according to the percentage of completion stages. How do we calculate 306,000? Well, that, colleagues, consists of the following. All right. So it is 1,496 times 360 divided by 1,760. Why do we do that? Because there's only 360 out of the potential completed of 1,760. How do we get 1,760? It consists of 1,400 plus 360 is 1,760. So we proportionate the employee rate costs on 1,760. A part of that is for work in progress, and the other part is of 1,190 completed. Okay, can you see we need to split the portion issued between work in progress as well as for the finished goods items? And that, colleagues, is 1,190 for completed and 306 for the other section. Well, they've also given us 138,190. 138,190 is variable cost. Yet again, we need to split the 138,190 on the units that we have completed and what is attributable to work in progress, only 60% complete. Again, colleagues, we will take 138,190 times 360 divided by 1,760 is 28,266. 138,190 minus 28,266 is 109,924. An easier way to calculate that. Colleagues, fixed overhead costs is allocated to production based on normal capacity. Therefore, we need to allocate it on the production units of 2,000 units. And therefore, it's 100,000 in total, 50 times 200. But again, we need to split it between work in progress and completed units of 79,546. And therefore, colleagues, the yellow items consist of your employee cost, which consists of 306,600, 28,666, and 25,554 for your normal capacity. That is for work in progress. The same appears for finished goods. Okay. They've given us the closing balance of your work in progress that you read from your additional information in the information of the question, which is 7152, and it is lower, the NRV is lower of cost, but you can't write it down purely because the standard tells us that when it is incorporated and the finished goods section that will be sold above the cost, then you can't write it down. Therefore, this will be your finished goods, your closing figure of inventory. And then, colleagues, the 629045 is the balancing figure for work in progress that will be transferred to your finished goods section. That is the items of those completed items, considering the 60% complete of the laptops. Critically important that you note that. Okay, therefore, you transfer the costs from your work in progress to finished goods items. Okay, so how do we get the balancing figure? Well, it's easy. It's your opening stock plus your purchases or transfer cost plus other costs less your closing stock give you your balancing figure of 629045. Then you will need your finished goods, and the procedure is exactly the same. It's 110,000 plus your transfer in costs plus your other costs, which is variable and overhead costs, fixed overhead costs, which we've just calculated according to this calculation table. And you get your closing figure, and that finished goods section is the cost of sales figure. Those are the total costs of the units produced based on our information. And you can see the finished goods costs is the costs of the item opening stock plus purchases less closing stock for your cost of sales items. But remember that we have allocated fixed production overhead costs according to a standard rate, which was 50 Rand at 2,000 capacity. Well, what was actually incurred? Well, we actually incurred 114,125. Now, we've only allocated 100,000, okay, to your production based on this scenario. Therefore, we've got an under recovery of cost, and we need to add it to your cost of sales, because you've actually incurred 114, but we've only allocated to production, so we've under exposed ourselves to the cost. Therefore, we need to increase the difference between the actual expenditure minus that was based on normal capacity, and that's 14,125. Therefore, consumables written off, net realizable value. Remember, I told you that packaging material or consumables does not form part of the finished items. That is an additional item. And they've given you the packaging material of 4,800. The closing stock figure is 44, and the net realizable value is 3,985. Therefore, we need to write off 400 Rand to your items. Okay. So the cost, the net realizable value is 3,985, and we've set with a value of 44. We need to write that off. So 4,400 minus 3,985 is 415. That is a write-off of your inventory items. Now let's take this figure. As you can see, the cost of sales figure is 2076680, and that, ladies and gentlemen, we can fill it in there as your cost of sales figure. Okay, what is the gross profit? Well, it's the revenue minus the gross profit, and then other expenses consist of your selling expenses, 7560. Okay, 7560 plus the 400 of the items that was taken down to your closing stock. Okay, so those are the that has been issued to the packaging material, and that's a cost of packaging material, and that's included in your other expenses. But we've already incorporated the written down effect in your cost of sales there for your consumables. And ladies and gentlemen, that's 7960, and your administrative expenses given to you as 206205 and 206205. There's not a lot more information to gather finance cost as other expenses, distribution costs, to be able to calculate your profit before tax figure. And then we can take the statement of financial position. We will have the consumables written off, which is 415, purely because they do not form part of the fixed cost items, which they are written down according to the standards. And then your inventories. What does your inventories consist of? It consists of raw materials, work in progress, finished goods, and consumables at the write-off value of 315, and that is 171735. 171735. Colleagues, and that is how you deal with the items on IAS2, where we have items that are only issued to production, but only a part of them has been completed, like we see in number 5 here. This is another question of a previous stock question that we did not include these two items. This is a more extended version of the calculation of your IAS2 cost of sales figure for IAS2. Colleagues, I would really like you to go through this. It's critically important that you understand the calculations. How do we arrive at the cost of sales figure? What, how and when we write down from cost to NRV when the items form part of the fixed cost, finished goods items. That is when you do not have to write it down. Under normal circumstances, you will have to write the items down as inventory is valued at the lower of cost and net realizable value. Colleagues, please go through this section, go through the calculations, and I wish you all the best of luck. Thank you.